All right, today we are diving deep into market momentum. We're going to put two of the biggest tools in any trader's toolbox head to head, the MACD and the RSI. We're going to see what they do, how they're different, and most importantly, how they can work together. You know, every single trader eventually finds themselves staring at a chart asking this one simple question. Is this thing I'm watching just getting started, or is it about to completely run out of gas? Getting that call right, well, that can make all the difference. And that's exactly where these two indicators come into play. So first up, let's meet the MACD. The easiest way to think about this one is as the trend follower. Its entire job is to help us figure out the strength and the direction of whatever trend is happening right now. So how does it actually do that? Well, MACD stands for Moving Average Convergence Divergence, which sounds complicated, but the idea is pretty simple. It's all about the relationship between two moving averages of the price. When those two averages start to pull away from each other, or diverge, that signals momentum is picking up. And when they start coming back together, or converge, it suggests momentum might be fading. Let's break it down real quick. You've got the main MACD line itself, which is just the space between a fast 12-period average and a slower 26-period one. Then there's the signal line, which is basically a smoothed-out version of that MACD line. But the magic, the thing everyone watches for, is the crossover. That's when one line crosses the other. And here is the classic signal in a nutshell. When that faster MACD line pushes up and crosses above the slower signal line, it's a hint that upward momentum is building. That's a potential buy signal. And when it crosses below, it suggests momentum is shifting downwards. That's your potential sell signal. It's a really foundational trigger for a lot of strategies. Okay, so now for our second tool, which tells a totally different story. This is the RSI, the Relative Strength Index. And if the MACD is our trend follower, I want you to think of the RSI as our exhaustion meter. See, the RSI doesn't really care about how two different averages are behaving. Its whole purpose is to tell us if a price move has just gone too far too fast. It does this by comparing the size of the recent up moves to the recent down moves to see if something is getting stretched, overbought or oversold. And the great thing is, it operates on this super simple scale from 0 to 100. There are two magic numbers here that traders are always watching. Anything above 70 starts to suggest that the market is overbought. Prices have shot up really fast and might be due for a breather. And a reading below 30 suggests the opposite. It might be oversold and ready for a bounce. Oh, and you're going to see this number 14 pop up all the time with the RSI. That's just the standard default setting. It means the indicator is looking at the last 14 periods, whether that's 14 days, 14 hours, whatever your chart is set to. You can change it, for sure, but 14 is the industry standard you'll almost always see right out of the box. Okay, so we've met our two contenders. We have the MACD, our trend follower, and the RSI, our exhaustion meter. Now, let's really put them side by side and see where they shine and where they differ. When you look at them like this, the core difference just jumps right out. The MACD is all about the relationship between two trend lines, but the RSI, it's measuring the internal speed of the price itself. This is why their signals are so different. MACD gives us these dynamic crossovers, while RSI gives us these fixed danger zones at 70 and 30. And it's why the RSI is stuck between 0 and 100, while the MACD can theoretically go as high or as low as it wants. And right there, that's the key. Because they're looking at the market through completely different lenses, they are not always going to agree. In fact, sometimes they're going to give you signals that seem to completely contradict each other. And understanding why that happens is so important. So picture this. It's a classic scenario. The RSI is flashing red. It's way up above 70, basically screaming that the market is overbought and due for a fall. But at the very same time, you look at your MACD, and its lines are still spreading apart, signaling that buying momentum is actually getting stronger. So who do you listen to? Well, here's the secret. The answer isn't to pick a favorite. The real power here comes when you stop thinking of them as rivals and you start seeing them as partners. They aren't meant to be used alone. They are, in fact, an incredibly powerful trading duo. And look, this is exactly how the pros think about it. They use these tools together to build a much deeper, more complete picture of what's happening. Each indicator has its strengths, and each has its weaknesses. Together, they help cover each other's blind spots. So how do you actually do that? Here's a really simple but powerful way to think about it. First, you use the MACD to get the big picture. Is the trend strong? Which way is it going? Once you've established that, then you bring in the RSI to fine-tune your timing. You can use it to look for those overbought or oversold spots to help you time your entries and exits within that bigger trend. So let's tie it all together with an analogy. Think of it like you're driving a race car. The MACD is the engine. It's telling you about the raw power and strength of the trend. The RSI, that's your tachometer. It's warning you if you're redlining that engine and are about to burn out. To drive well, you need to be watching both. So I'll leave you with this final thought. The next time you're looking at a chart and you see these two indicators telling you two different stories, don't get frustrated. Don't see it as a problem. Instead, ask yourself, what is this disagreement telling me about the conviction in this market? That uncertainty might just be the most important signal of all.